Hello, good afternoon, and I hope we are all doing well. All right, so we are back here again, and today we will be going about on how we are going to, or how tutorial set 2 should be solved, right? So to make the video short, right, this time around I've tried my possible best to solve them before I come online to come and then explain how I arrive at those answers, right? So if you remember, last semester, what I'll do is I'll come and solve everything again online and then to make the video long. But this semester, for example, tutorial set 3 is like it has a whole lot of questions, but I've solved them already. Mine is to come here and then explain how I arrived at those answers. So for example, here it's 11 pages, right? Yes. So we are going to dive in right now. So quickly, kindly like this video and also subscribe to the channel and also share this video to others who might need the video. All right, thank you very much. And as you guys know, I'm Nehemiah, I'm also known as Oracle. All right, so to begin with question 1 on taxation tutorial set 2. So question 1 is saying that for an expenditure to be an allowable deduction, there must be a direct connection between the expenditure and the business, right? So basically, let's attribute this to say pregnancy, right? Before you accept a pregnancy, as a guy, before you accept a pregnancy, for example, then it means that you've done something with the lady, right? So that's basically what this is talking about. So before before an expenditure will be allowable as deduction, then there must be a direct relationship between the expenditure and then the business, right? All right, so here we are required to discuss this statement in line with the provision of the Income Tax Act 2015, Act 896, right? So this is the suggested answer. So unless otherwise required, the Commissioner General shall not allow expenditure. So you, for example, you as a man will not accept any pregnancy unless there is a direct connection between you and the lady, unless you have done something with the lady, right? So Section 9 of the Income Tax Act of 2015, Act 896 amended, thus expenses deductions are deemed to have a direct and intimate connection between the business, with the business, right? So between you and the lady, for example, I'm just quoting some kind of. So thus, the expense is wholly, exclusively, and necessarily incurred by the person in the production of the income from the business during the year, right? We are talking about the year of assessment, right? So basically, before someone will tell you, say, as a man, before someone come and tell you, say, I'm pregnant for you, then it means that you've done something that is wholly attributed to the pregnancy. Maybe you use because you satisfy some kind of pleasure with a lady, right? And then necessarily, it's more or less like something that you did to make that pregnancy come into action, right? So basically, let's relate this one to business. So when we talk about wholly, it relates to the quantum of amount being charged. The amount should be for the purpose of the business. So whatever you charge for a particular business as an expenses should be for the purpose of that business. The amount should be related wholly to the income of that. So any income that you had from that particular business, that expenses should be charged to it. So when we talk about exclusively relates, let me check whether I'm recording before I'll talk like I spoke a whole hour or something and then I realized that I wasn't recording and also I wasn't. So exclusively relates to the purpose for which the expenses was incurred, right? Expenses must be relevant to the operation. Maybe you were so zonny and you needed that lady to cool your destiny, right? That's why what that destiny occurred. So they must have a bearing in the operation of a business. You did something to make that pregnancy came. All right, so necessarily connote some form of compulsion on the taxpayer. So the expense must be inevitable, right? The way you were so this thing, if you don't do that thing, right, you wouldn't be maybe able to sleep or something, right? So just really, so in other words, the business cannot go on without incurring the expense, right? So basically, the deduction or expenses are not of capital nature. We spoke about some expenses that are of capital nature, like buying fixed assets or doing a signboard, advertisement on a signboard that will last more than 1 year, right? They are all of capital nature. Good expense secure, that secures a benefit that lasts for more than 12 months or 1 year. All right, so that is it for A. Let's go to B. So B is saying that according to the Act 896, the Commissioner General shall not allow a deduction in respect of domestic expenditure and excluded expenditure incurred by a person. So excluded expenditure are expenditures that will not be included or that is not like allowable. Ankasa. So let's talk about them here. So domestic expenditure. So where an individual incurs, expenditure in respect of that individual. So when you make any expenses relating to you yourself, the expenditure is domestic expenditure to the extent that it's incurred in maintaining the individual, including provision of shelter, meals, refreshment, entertainment, or other leisure activity. Let me make the font a bit. Let me see. All right. All right. So in maintaining the individual, including the provision of shelter, meals, refreshment, entertainment, or other leisure activities, right? So by the individual commuting from home to work, so any lorry fare that you pay from home to work is not allowable for deduction. And also in acquiring clothes for the individual other than clothes that is not suitable for wearing outside work. So when you acquire anything that will be used purposely for work, like example, uniforms, working gears, Wellington boot that is specifically used for that particular work, then that particular expense is deductible. But if in case you buy something that can be used during work and also when you close from work, you can use it. Like for example, suits or a normal shirt, then it is not allowable for deduction. Then in educating the individual, other than the education that is directly relevant to a business conducted by the individual and that does not lead to a degree or diploma, right? Then excluded expenditure. Excluded expenditure. This means that tax payable under the Act, tax that you are allowed to be allowed to pay. Then bribes and expenditure incurred in corrupt practices are not allowable for deductions. Interest, penalties, fines, or a fines paid or payable to government or a political subdivision of a government of any country for breach of any legislation is not allowable for deduction. Expenditure to the extent incurred by a person in deriving exempt amounts of final withholding payment is not allowable. Retirement contributions, unless they are included in calculating the income of an employee. The dividend of a company. Let's keep this in mind. Dividend of a company, right? Okay. So C. Let's look at question C. Question C. State the circumstances under which bad debt will be allowed. Right. So you remember in our normal business or in our normal accounting, bad debts are normally added to our expenses. But the taxman doesn't allow anything as bad debt to be used as an expenses. There are some specific bad debts that are allowable for deduction. So specific bad debts are allowable for deductions and the like. So let's look at it here. So the bad debt should be specific and not general bad debt. So in any taxation question, when you see general bad debt, then it is not allowable for deduction. But when you see specific bad debt, then it is allowable for deduction. The bad debt should arise out of ordinary course of business. So the bad debt should relate to the particular business that you are doing. If you are selling phones and someone comes to buy the phone, and then that on credit, and then that particular uh, amount becomes bad, then it is fine and it's allowable for deduction. But if you are selling the phone and someone comes to buy, let's say, your shirt, and then the person doesn't pay the money, that particular listing doesn't or is not allowable as a bad debt because it is not related to the business, right? Okay, so the amount should have been included in the previous year's income. So in your income, the amount that you sold, right, should be included in the particular revenue that you've declared to the taxman. So there should be evidence that you've taken necessary steps to recover the debt, but in fact, maybe the person has gone mad, so you've tried your possible best. The person is not the home tunnel, and maybe the person too has died, right? And the like. So there should just be evidence that taking necessary steps to recover the debt, but in fact, then that will make that particular bad debt allowable for deduction. All right, so let's go to question 2. Your company recruited 5 new employees, and the director of training has instructed you to explain certain provisions in the Income Tax Act 2015, Act 896 to them. So research and development, right? So as a trainee, so we are required as a trainee, explain the following. First is research and development. All right, so research and development expenses meeting the requirement of wholly, right? Because that pregnancy, for example, you did something to the lady, right? Then that any expenses that you are going to make will what? Be because it is what? Wholly, exclusively necessary incurred during the year by the person and in the production of income from the business or investment. This may be deducted irrespective of whether they are of capital nature or like revenue nature or anything like that. So research and development expenses means expenses incurred by the person in the process of developing the business and improving business production process. So if you're improving business production process or improving your your goods and services, then it tends to as what research and development. So research and development expenses exclude expenses incurred that are otherwise included in the cost of an asset used in the production. So let's say if you're improving an asset, it is not what research and development. All right. So that is it for that one. Then contribution and donation to worthwhile causes, right? So this can include contribution to orphanage and also, okay, so it's here. A person may claim a deduction equal to contribution and donations made during the year for worthwhile cause that has been approved by the government. The following are worthwhile causes. So donation or contribution to a charitable organization is there. Donation or contribution to a scheme of scholarship or cause of study. Then donation or contribution towards rural urban development. The rural urban development like Ikrasi Fund. Then donation or contribution towards sports development or promotion. This sports and development promotion is basically like supporting Ghana Blasters and not, let's say, any other destination. You get it? So it should be the national destination. So Ghana Black Stars or Black Queens or those kind of not Bekum Chelsea and the like. Then other worthwhile causes approved by the Commissioner General of the Ghana Revenue Authority. All right, then financial cost from derivatives. So financial cost is interest or losses with respect to a financial instrument, and it is tax deductible, but it has some terms, right? So the debt claims or debt obligations, then it should be what? A derivative instrument and a foreign currency instrument. And then, so debt claims is more or less like you are going to receive some kind of money, and the debt obligation is more or less like you are going to pay some kind of money. And then a derivative instrument, as we know already, and then a foreign currency instrument, any other instrument prescribed by the regulations, treated as financial instrument by generally accepted accounting principles. So the amount of financial cost should not exceed, right? Keep this in mind. We will use it to do some calculations down there. So it shouldn't exceed the financial gain that you get plus 50% of the adjusted chargeable income. Remember, whenever we are computing our profits for a particular year, we include our financial gains and then we include our financial cost, right? So we have to adjust that and then add, because we subtract financial cost, we now add the financial cost back, and because we add financial gain, we now subtract financial gain to get our adjusted profit, and then now we find the 50% of it. Then we add it to our financial gain that's already existing. We will solve some question and then we will understand this better. So financial gain derived by the person that are to be included in calculating the person's income from the business or investment for the year of assessment. Then 50% of the chargeable income of that person, it is adjusted chargeable income of that person for the year. Just chargeable income of the person for the year from the business or investment calculated without including. All right, so that's it. Okay. Without including financial gain derived by the person and also deducting financial cost. So that will make it adjusted chargeable income. Financial cost for which a deduction is denied because of the above rules may be carried forward and treated as incurred during any of the following 5 years. Carry forward are used in the other in they are incurred. So more or less like first in, first out method, right? So what this plenty gamma is basically saying that your financial cost that is allowable by the government or by the GRA is your financial gain plus 50% of your adjusted chargeable income. That's basically it. All right. So question 3, because I've solved it and then I'm just reading it out. That's why we are moving fast like that. If I was to write everything again, you would have seen that in year question 1 can put. All right, so question 3 is here. This is where we are going to apply what we were saying in the previous listing. So the following details were taken from KK Company Limited for the year 2020 of assessments. Profit before taxes, 132,000. The following were included in arriving at the net profit. So total financial gain for derivatives and total financial cost from derivatives. Here is 42,000, here is 300,000. Then state what constitutes financial cost from derivatives, right? So state what constitutes finance. So that's one. Financial cost here is the interest or loss with respect to financial instruments, right? Interest or loss with respect to financial instruments. And it is tax deductible up to the limit defined by the amended. So which is, it is for the financial gain plus the 50% of the adjusted chargeable income. So a debt claims or a debt obligation. So these are the what constitute a debt claim or a debt obligation. So a debt claim means right to receive a payment, and a debt obligation means Debt means an obligation to make a payment to another person denominated in money. So debt obligation includes accounts payable, the obligation arising under debentures, shares, treasury bills, promissory notes, bills of exchange and bonds, a derivative instrument. All right, so a derivative instrument is a financial instrument or other contract with all three of the following characteristics. So its value changes in response to the change in specified interest rate. So the value of a derivative instrument changes, right? Financial instrument price, it changes with interest rate, instrument price, commodity price, foreign exchange rate index of prices or rates, credit rating or credit index, or other variables provided in the case of non-financial variable that the variable is not specific to a party. So basically, what this means is that a derivative instrument is an instrument that changes value within, like it changes value anyhow. So meaning it's volatile. That's what it means here. So it requires no initial net investment or an initial net investment that is smaller than would be required for other types of instruments. So at least you need to pay something down. So it is settled at a future date. A foreign currency instrument and any other instrument prescribed by regulations or in the absence of regulations. So basically, all these answers were taken from the ICAJ website so that we go with the marking scheme. So um, the amount of financial cost should not exceed the total of financial gain. So we've spoken about this by the person that is to be included in calculating the person's income for the business or investment for the year of assessment. And 50% of the chargeable income of that person from the year from the business or investment calculated without including. So that this is basically the adjusted chargeable income. We will talk about this normally. Financial cost for which a deduction is denied as a result of the above rules may be carried forward and treated as incurred during any of the following 5 years of assessment. All right, so basically that's it. They are carried in order when they are incurred, like the people or whatsoever. So now let's look at the other part here. So we've spoken about 1 and then 2, AI and II. Or we've explained the tax treatment for the derivative. That's what we just said, that it will be carried forward in the 5 years. So it is the financial gain plus 50% of the financial adjusted chargeable income. Right. So I compute and explain the allowable financial cost from derivatives. So we are going to use this to compute them. Remember, in arriving at this profit, this and this was added. So you have to take this financial gain was added and financial cost was subtracted. So we have to add back financial cost and then subtract financial gain to arrive at our adjusted chargeable income, right? So that's what we just did here. So the net profit, then we add back the finance cost, then we less our finance gain. Then this is what we arrive at, the chargeable income after adjusting or adjusted chargeable income. Then now, our financial gain, remember, our financial cost, remember, is the financial gain plus 50% of the adjusted chargeable income. So 50% of this is what we are getting here, right? 50% of this is what we are getting here, right? So 50% of this is here. So 42,000, which is the financial gain, plus 50% of this, of the adjusted this thing, then we are getting an allowable financial cost of 237,000. This is it. All right. So now the allowable financial cost 237. The allowable financial cost is 237,000. However, the total finance cost was 300,000, as we are seeing from here, right? So what we are going to do is this allowable finance cost is for this particular year of assessment, right? So the remainder will be carried over for the next 5 years. So if you are able to recover everything in the next year, fine, you are done. But if you recover parts, or if let's see, you check adjusted chargeable income again, and then you add your finance gain and finance cost, and it is still more than the 63,000, which is the difference between the 300,000 and 237,000. Then that difference again will be carried on to the next year again. So you get it. So now in this year, this particular year of assessment, we will be treating only 237,000 as our allowable finance cost. Then in the subsequent year, you will treat the difference, right? So the difference is the 3,000 would be allowed and may be carried forward for the next 5 years. So that's it behind this explanation. That's it behind this solution. All right. So then let's look at it again. Ivan is saying assume all the facts are the same, except the financial cost and from derivative is 60,000, and financial gain from derivative is 60,000, and financial cost from derivative is 30,000. Compute and explain the allowable financial cost, right? So basically now they've changed only this, and we have to do everything over again, right? So that's it here. We use the same steps, the 130,000, we add back finance costs. Now the new 30,000, then we less finance gain, the new 60,000. Then this is what we arrive at, 102,000, right? So now this is our adjusted chargeable income. So now it will be our finance gain plus 50% of it. So our finance gain plus 50% of the adjusted chargeable income. So the adjusted chargeable income, 50% of it is 51,000. That's what we are getting. So when we add it, our allowable finance cost is 111,000, right? It's 111,000. But look at it. Our finance cost here is 30,000. But the allowable is what? 111,000. We wouldn't be allowed to subtract more than our actual finance cost incurred when the allowable is higher than it. So basically, what we are going to pay as or deduct as finance cost will be our normal finance cost. But in case it was higher than the 11,000, right, then 11,000 will be paid, and then the difference will be carried on to the next year or the next 5 years, right? Tax money there or smart too much. We had the baby. So now because the finance cost is actually 30,000, and 30,000 is going to be paid this year. So basically, that's it here. Allowable finance cost is 111,000. The total finance cost was 30,000. This means that all the 30,000 would be allowed as finance cost for the year of assessment. So we are not going to use the 111,000, but the 30,000, because it is lesser than the finance cost. So in the situation where the finance cost is lesser than the allowable financial cost, then the financial cost is going to be used as the allowable financial cost. All right. So let's look at question 4. Question 4, the determination of a person's tax liability is in relation to the concept of year of assessment and basis period. Remember, in tax principles, which is I think lecture 3 or 4, so we spoke about it. right? And then I told you that the year of assessment is the bigger picture and the basis period is the smaller picture in the year of assessment. So now, year of assessment is the government's calendar year, or is the year in which taxes are levied and collected. Whilst the basis period is the year by reference of a business. So it's more or less like within the year of assessment, the number of years, the number of months, weeks, or days in which a business operated, right? Or a business made profit within that particular listing. So if the year of assessment is January to December, from January to December, within any of the period in which a business worked or a business made an income is the basis period. That's basically it. So in relation to the statement above, distinguish between the concept of year of assessment and basis period as used in income taxation. So that's what I've explained. The year of assessment is the year in which taxes are levied and collected. And it is normally the calendar year in the case of Ghana from January to December. And the basis period is the period in which a business like made an income or operated within the year of assessment. So I used January to December as the year of assessment. And then I said that if the business made an income within any of these months, within a year, right, that becomes the basis period for that particular business. So let's look at what is on the marking scheme. So year of assessment is the income tax or the year in which taxes are levied or collected. It is referred to as the government fiscal year or budgetary year. In Ghana, it is the calendar year, which is from January to December. So basis period is the period reference to which the assessable income of a person is computed in accordance with the provision of the Income Tax Act 2015. This is the marking scheme. Act 896 as amended. So it is what? Normally 12 months period, right? And it cannot be more than 12 months period. However, it can be less than 12 months during the year, like during commencement. So if let's say you have your year end to be, let's say, December, 31st December, whilst you started business at, let's say, April, then you'll be operating less than 12 months in the first year, right? But in the subsequent ones, you'll be operating full years, right? So I state the basis period for the following persons as provided in the Income Tax Act 2015. So sole proprietorship, a company, a trust, and then a partner of a partnership. So basically, for sole proprietorship, right, and a partnership, they use the calendar year, right? But for companies and trusts, they use the accounting year. So let's look at it here. So you can see a sole proprietorship uses the calendar year, company uses the accounting year of the company, a trust uses the accounting year of the trust, and then a partnership uses the calendar. Remember, the calendar year is from January to December, right? January 1st to December 31st. That's the calendar year. And then the accounting year of the company depends on each and every company. Some companies might be from January to December, and then others too can also be from April to 31st March. So it depends. So any businesses, this thing. All right. So let's look at C, question 4C. So Hajia Bintu has been in business from 1st September 2018. Remember, 1st September 2018, preparing accounts to 31st August each year, September to August. She ceased to operate the business on 31st May. See the way I'm stressing on the date. She ceased to operate the business on 31st May 2023. The agreed profits for the past years of operations are as follows. So year to 31st August 2019 is this. Year to this 31st August 2020 is this. Year to 31st A 30th August 2021 is this. Year to 30th August 2022 is this. Then period to 31st May, meaning it's not up to 1 year, is this. This profit is not up to 1 year. So it's not up to 12 months, sorry, it's this. All right, so calculate the assessable income for all relevant years. So we are calculating the assessable income for all, right? So we calculate each by each, then we add all of them later. So this is it here. All right. So remember that Hajia Bintu is not a company. It is a normal business. It is like a sole proprietorship, right? And a sole proprietorship, the basis period is for the calendar year. So we are going to calculate its basis period within the calendar years. So it is within January to December each and every year. So among these revenues, we are going to apportion how many months they worked in each of the calendar years. So year to 30th April 2019, their profit is what? 18,000. So we are going to start computing from the 2018 year of assessment, right? So the 2018 year of assessment will start from 1st September 2018 to 31st December 2018. This is because he started doing the job at 1st September 2018. So we are going to start everything from 1st September 2018 to 31st December because it will be within the what? The calendar year. Remember the calendar year is from 1st January to 31st December. So any month within this calendar year will be assessed or will be apportioned, right? So and they work from September to December 31st in that particular year 2018, right? So 2018 will their income, this thing will start from September. So September they worked, October they worked, November they worked, and December they worked, which is what? 4 good months. 4 months, right? So if we want to know the amount of revenue in the year 2018 within this one, then we are going to multiply this particular revenue times 4/12 because that's the number of months they worked in here. So 4/12 will be in here, right? So remember that it is up to 2019. So from this side up to 2019. So we are going to take only the 2018 aspect out. So in 2018, this is it. The 18 million times 4/12, and we had this 6 million, right? Now in 2019, remember 2019 will start from the calendar year will start from 1st January 2019 up to 31st December 2019, right? But we have our destiny is ending on 30th April. This particular revenue is ending of 30th August, right? So we have to take that part that is in here out. So remember, first, in the simple terms, right? First, we computed for 4/12. So 4/12, it will be left with 8 months in there. So we are now just going to use 8/12 times this amount because in the year 2019, we will work 8 months from 1st January to 30th August. It's 8 months. So 2019 is going to be 8/12 times this particular revenue, right? Then in the same year 2019, remember it is going to start from 1st September 2019 up to that particular, up to December. And that revenue sum is in here, right? So it is going to be 8/12 times this 18 million plus from 1st September in 2019 up to 1st September, up to 31st December in 2019 in this revenue. So 4 over 12 times this 23 million. So that's the same thing we are going to use there. So in a simple form, just use 8 over 12 times the 18 times 4 over 12 plus 4 over 12 times the 23. Then you get this. And see, it's easy. Just look into it well. Keep the date and time in mind. That is how you are going to get this in the easiest form. So within the year 2019, it will start from January to December, right? And from 1st September, from 1st January to 30th August, we are having this revenue within here. Remember, here is up to from 1st. So in the year 2019, we have from 1st up to 1st January up to 30th August in here. And each revenue is attributed, some is within here, right? So the one that is within here will be 8 months. Then the rest will be 4 months. Then we do it to the next one, right? So that is basically it. That is the basic knowledge we are using here, right? So the next one, in the year, for the year 2020, right, we will now be having from 1st September to 31st December, which is what, 4 months in there. So that's basically it here. So in the year 2020, the basis period is from 1st January to 31st December, right? 2020. And remember, we will be having we'll be having from 1st January to 30th August. 1st January to 30th August here within this revenue. So that's what we are doing here. 1st August to 30th August. We'll have this revenue, 23 million. So you have to apportion it. And then now it will be left with 4 million. So 4 million will be within this year. Sorry. So 4 months. It will be left with 4 months for that particular. So the 4 months will be within this. So here too, the year will end at 30th April. So it will be left with what? 4, which is from 1st September 2020 to 2021 to 1st September 2020 to 30th December 2020, right? So that's what we are going to do here, the same thing. So from 1st September to 30th, 31st December, that's it here. So we add the 2 and then we bring it here, the same thing. The same thing will also happen to 2021. We will work from 1st up to 30th August. We multiply it by each particular associated revenue plus the 4 months that will be left for the year, the next one. We do the same thing. Here too, we are going to do the same thing here. Same steps now. Remember, for the year of assessment, is going to be what? From 1st to 1st January to 31st December. So anything that, any days or any month that you'll be working within that year, or any income that will be generated within that particular 1st January to 31st December will be your accessible income for that particular distance. So that's what we are doing. So this one also is going to be the same thing. So once you get the first one, you will just be applying it the same thing throughout, right? So here, because we will be working from 1st to 30th August, also in 2022, our destiny is going to be from 8 over 12 times that particular revenue associated to it. Yes, so 2022, we are going to work from 1st January to 30th August. Our accessible income is going to be within that one. So it is going to be times this particular revenue associated to. Now it will be left with what? 4 months for the next listing. So 4 months times the 50 million. Remember, the next one is only 9 months because it is from 30th August up to 31st May. That's why here it's changed to 4 over 9 because it was only 4 over 9 months. in that where it ended, it didn't end at December, so it is only 9 months. So 4/12 times 50 million. That's what we are seeing. Now it will be left with 4/9, sorry. Now it will be left with 5/9 here. Right? So 5/9 times the 50 million. Then we get our distance. So when we add all of them, we get our total chargeable income, a total accessible income, right? So that's basically it. If you have any further questions, you can ask in the comment section and then I will explain further. Right. Right. Thank you. So let's move on to the next question. So question 5, with reference to the Income Tax Act 2015 Act 896, states the general and residential rules governing the settlement of persons' income from business and investments. So the general deduction, the Commissioner General shall not allow a deduction in respect of domestic or excluded expenses incurred by the person. Remember, we've spoken about domestic and excluded. Domestic is basically something that you incurred for yourself, like buying clothes, shelter, and those kind of stuffs, except say it is a working gear or something like that. Or an expense that is more or less like transportation to work is not allowable for deduction. And excluded is what? A tax payable by the person, and also bribes, corruption, and paying whatever. Those are the. Then a specific deduction rule shall take precedence where more than one deduction rules apply. So if there is more than one deduction rule, then they take in order of what they incurred, like first in, first out, and the likes. All right, so residual deduction rule. In calculating a person's income from conducting a business or investment for a year of assessment, deduct expenses to the extent that they are wholly, exclusively, and necessarily incurred during the year by the person in the production of income. I don't need to re-explain this. I've explained this already. Income from the business or investment. No deduction is allowed for an expense of capital nature. I've spoken about capital nature expense. Then in this session, so capital expenditure, we've spoken about capital expenditure already. And then also revenue expenditure. So the full benefit of expenditure is consumed for more than one accounting year. So that's for revenue expenditure. It is an expenditure incurred for the day-to-day running of the like rent, stationery, normal expenses, and the like. The full benefit is consumed in one accounting period, right? All right, so now let's look at another calculation here. So 5B, Agoo Ltd run a business with a basis period from January to December each year. The following, remember they didn't say 1st January to 31st December, but you have to assume it that way. The following information is relevant to each business operations for 2022 year of assessment. The chargeable income from business operations was 480,000. The chargeable income was arrived after the following adjustments were made. So meaning that the chargeable income is already has an inclusion of this already, financial cost and financial gain. So now they said we should compute the tax payable for the 2022 year of assessment. Then we should also advise the management on the result. So like what we did already, we have to find our adjusted chargeable income. And then in order to find our adjusted chargeable income, we have to what? Add back the finance cost and then also less our financial gain. Right. So when we get the adjusted, so now it is going to be our financial gain plus 50% of our adjusted chargeable income. So 50% the adjusted chargeable income is this. Yes, is this. And then now our allowable finance cost is what? 1.5 million. All right. So now if we want to compute our tax payable for the 2022 year of assessment, chargeable income is what? 480,000. Then we add back our finance costs, right? But finance gain is already included, so we leave it as it is. Then we arrive at this figure. Then now we less our financial cost, like the allowable one, which is this one that we just computed. All right, we less it, then we get what our actual chargeable income, which is what 780,000. Then we now find our 20% tax, which is what, which is the 195,000, right? Remember that the only difference here is that when we are computing our taxable payable thing, our financial gain is added to the thing already. So we only include our financial gain in here. What we are going to do as adjustment is only the financial cost. But in case we want to find our allowable financial thing, we have to remove them, both the financial gain and financial cost. But if we are doing only the computation, it's only the financial cost that is what being taken out, being added back to the thing. All right, so this will be it. And then now the cost incurred from hedging was what? 1.8 million. The allowable cost incurred is what? 1.5 million. So the financial cost itself is what? 1.8 million. But the one that is allowable, according to the Tax Act, is what? 1.5 million. So what are we going to do? We are going to only be allowed to what? Pay that particular 1.5 million. Then the 300,000 will be carried forward for the next 5 years, right? Thus it is being granted in the order in which they incurred. So management should in future be mindful of the implication of costs on derivatives as they are allowable wholesale, as they are not allowable wholesale, like they are not allowable wholly, but restricted in accordance with the section 16 of the Act, right? So now question 6 to end this video. Question 6 is the final one. If not that I've solved everything already and we are just like, and I'm just explaining, like you're not even up to this point. So question 6A, assume that the written down value of asset in pool 2 is 100,000 Ghana cedis and repairs and improvements are 20,000. What will be the tax allowable expense? Remember, according to the Act, repairs and improvements should not be more than 5% of the written down value. So even though the repairs and improvements is 20,000, the allowable one is only going to be 5% of this 100,000, right? Let's check it out. So the tax allowable expense is only 5% of the 100,000, which is what? Which is what? 5,000. So the amount that is left will be capitalized to the asset, right? We'll add it back to the asset, to the value of the asset. So meaning that the allowable tax expense is only what? 5,000 and not 20,000. Right, B. Kabute stores, I think this came into our eye plenty. Kabute stores expenses of incurred expenses of 2,500 on repairs and improvements of plants and machinery, and declared a profit of what? 100,000 for the 2016 year of assessment. Note that the written down value of the applicable pool before capitalizing any excess is 60,000, right? Here, remember, here is the profit that is 100,000, but the written down value is 60,000. Don't confuse yourself. Here, the written down value is 100,000, but here is for 60,000. So they are telling us to determine the allowable amount for repairs and improvements. Remember, it is only going to be 5% of this. But in the case where the 5% of this is higher than the actual expenses incurred, then we use only the expenses that was incurred. So let's look at this. So allowable amount for repairs and improvements of 5% of the 60,000, which is giving us what? 30,000. But he won't be allowed to enjoy more than he incurred. So 2,500 will be his allowable amount, right? Okay. Then II is asking us, determine the excess amount of repairs and improvement to be added to the depreciation basis of the applicable pool. Remember that the allowable distance is what 30,000, 3,000, sorry. But the actual expenses incurred is for 2,500. So the excess amount will be what? Will be insignificant in the sense that since the allowable is higher than the expenses incurred, then the excess amount to be added to the depreciation application is applicable pool is what? Nil or zero. If like the allowable amount is 3,000 here, and then the actual expenses incurred is 5,000, then the difference, which is 2,000, will be the excess to be added. But in this case, so if let's say here, if in case here was, let's say 5,000, right? Just let's say if here was 100,000, right? Sorry, 6,000. So if here, if the actual expenses incurred was 5,000, then the amount to be added to the excess is going to be into brackets 5,000 minus 3,000, which is going to be 2,000. So like 2,000 will be added to the excess, will be the excess amount to be added to the depreciable pool, because the actual expenses is higher than the allowable amount. But in this case, the allowable amount is higher than the actual expenses. So meaning that nothing will be added to the depreciable pool. That's basically it. All right. So let's move on. So this is because its expenses on repairs and buildings is lesser than the allowable amount for repairs and improvements. All right, so let's look at C. C is saying that Morena Limited incurred expenses on repairs and improvements of 6,500 on plants and machinery. Also declared a profit of 100,000 for the year of assessment. Note that the written down value of the applicable pool before capitalizing any excess is 60,000. So we should determine the allowable amount for repairs and improvements, right? So allowable amount is for 5% of the written down value. This is going to be what? 3,000. Then excess amount for repairs and improvement is going to be what? 6,500 minus the 3,000, which is going to give us what? 3,500. So let's look at it here. So allowable amount for repairs and improvements is what? 3,000. Excess is going to be 6,500, which is the actual expenses incurred minus the 3,000 here, which is going to give us 3,500. That's basically it. Let's look at D. Okay, question 7 is even there. All right. So D, Sherry Limited incurred expenses on repairs and improvements, 6,100 on a plant and machinery, and declared a profit of 150,000 for the year 2022, year of assessment. The written down value of the applicable pool before capitalizing any destiny was 60,000. Based on this preamble, we are required to determine the deductible amount for repairs and improvements. So basically, 5% of this will be the deductible amounts for repairs and improvements, which is going to be 3,000. Then the excess amount of repairs and improvement to be added to depreciation is going to be 6,100 minus the 3,000, which is going to give us 3,100. Then adjusted profit is going to be 150,000 plus this 6,100 minus the allowable distance, which is 3,000. So we are going to get, I think, 153,100. So basically, this is it here. Adjusted profit is going to be the profit plus the added expense. So this was what was deducted before arriving at this 150,000. So we have to add it back and get 156,100, right? Then we now less our allowable repairs and deduction. 300, 3,000. Then we get 153,100. So we see how simple it is. So easy and straightforward. All right, so that is it. So let's look at question 7. That one is so simple. So Nyanya Mining Limited is a mining company incorporated in Ghana. In 2019 year of assessment, the company furnished the Ghana Revenue Authority with the following. Revenue is 10 million, cost is 2.5 million, gross profit is 7.5 million because when you subtract the cost, you get this. Then less operating expenses is what? 8.1 million. So they arrived at a loss of 600 million. 600,000. Shika paid a dividend of 50,000 to Nyanya, which has been added to the revenue. So this dividend added to revenue has to be taken out of the revenue. And upon scrutiny, it was reviewed that Nyanya Limited has 25%. So according to the law or the Tax Act, if a firm owns or if tax is being paid, the dividend is being paid to resident company by another resident company, right? Tax is exempted. Where the company receiving a dividend controls or directs at least 25% of the other company, right? So so since it's controlling 25%, then tax is exempted, right? So the operating expense operating expenses included this filing penalties. Remember, filing penalties is what? An excluded deduction or excluded expenses. So 1,000 capital work in progress, 200,000 depreciation. These are all disallowable expenses. So it was agreed with the Ghana Revenue Authority to grant a capital allowance of 300,000 for 2019 year of assessment. The capital allowance is yet to be restored into the computation of returns. So here they are telling us to compute the loss to be carried forward. So this is our net profit, which was a loss of 600,000. Remember the dividend was paid, was received, right? And then it was added to revenue. So we have to take it out. So we take the 50,000 out, then we arrive at 60,000, 650,000, right? Then now because this allowable deduction was subtracted, now we add them back. So after adding all this back, all right, we get a total of this thing, 301,000. Subtracting this, adding this to this, we are arriving still at a loss or at negative 349,000, right? Then we less our allowable deduction. We less our allowable deduction, which is 300,000 as the capital allowance. So now our loss to be carried forward is going to be what? 649,000. That's basically it, right? So you see, we add back the disallowable expenses, then we take out the allowable expenses and then we arrive at this. That's it here. All right. All right. So basically, this is it for tutorial set 2. Very soon I'll do for tutorial set 3 and then 4. I think 4 needed also, but I'll try my possible best and finish it. All right. All right. So kindly like this video and also subscribe to this channel. Share this video to your friends who might need it. Thank you very much for your time. Have a wonderful day. Bye.